Let's go into the pros and the cons. Give me the pros of it, and then give me the cons of it.
Yeah, so the number one pro is to sell high, buy low, right? The ability to sell high and then diversify and buy low when it makes sense for you, right? You no longer have to equal greater value. The second thing would be a new depreciation schedule, right? Realize that depreciation is one of the number one reasons to own cash flow producing real estate because it offsets the income that's coming in, right? That is one of the unique parts about real estate. Well, guess what? If you've owned multifamily for 27 and a half years or commercial for 39, your depreciation schedule goes to zero and you lose one of the biggest benefits. Well, in a 1031 exchange, if you exchange, guess what? It's blockbuster. Your old depreciation schedule travels. Not so with the Deferred Sales Trust. Remember that deal in Minnesota? Well, he bought back that property. He got a brand new depreciation schedule. Why? Because he used IRC 453, which is an installment sale, right? And he partnered with the trust to buy it back, which is a very important way of doing it. He got a brand new depreciation schedule. So that's very powerful. So that can really save you there. The third one would be the ability to move your funds outside of your taxable estate. So one of the things that most folks in commercial real estate we've been taught is 1031 and swap into your drop and then get the stepped up basis. Okay, by the way, Biden is talking about taking that away. We'll see what happens. Hopefully he doesn't. But if that happens, we're losing one of the number one benefits. But the other part of that has to do with estate tax, guys. Estate tax right now is if you're married, 22 million is exempt, 12 million single, but anything above and beyond that, you're hit with a 40% death tax. So the intent is to get it out of your taxable estate. The challenge is the 1031 nor the stepped up basis doesn't apply to estate tax. So I'll give you an example. Working with the client right now, he's worth about $52 million and he's lived in Texas and he's learning about the Deferred Sales Trust. He owns mobile home parks, multifamily. And his biggest challenge is, Brett, I need to get this outside my taxable estate. I don't want to give it all away to charity. Can the Deferred Sales Trust move it outside my taxable estate? And the answer is yes. And so we just closed another deal in Colorado. It was a $25 million client, and they had a $5 million multifamily property they were selling, and they had all 25 inside their taxable estate. They sold, moved it outside their taxable estate. So that's going to save them 40% for their heirs. Okay, has nothing to do with the stepped up basis, nothing to do with capital gains taxes. So just you got to do their math. You have to underwrite your exit strategy, right? And the way I'm coming out with the book soon, and I think we're going to call it tax flow quadrant. It's no longer about, managing your cash flow. It's managing your tax flow and how and when you're going to pay tax. And when you look at these things and understand that tax is your biggest expense and the biggest root of that will be ripping out that estate tax if you're worth ultra high net worth, well, you can defer that and move it out, and you can move it outside your taxable estate. And the Deferred Sales Trust, again, is transformational.
Who shouldn't be using this? Anybody who shouldn't be using it?
Yeah, so I guess on the cons or not so much. The first thing is you got to get used to me as the trustee, right? And now I'm a third party, unrelated trustee. The biggest thing is, who is this guy? Can he take my money? First of all, funds never move without your signature. You have 24/7 access to view the funds. So if you're under a quick time crunch, right? We've tried to educate and get the content out and get to know us and our partners and everyone else. That can be challenging for people to get overcome. Like, I'm closing in a week and oh my gosh, it's my biggest deal I've ever done. And now you're telling me something new. So it's not that they shouldn't be using it, Gino. It's that it can be challenging if you're not taking action to make a plan today. The second thing would be your deal's too small. So $1 million net proceeds and $1 million gain is our minimum. Why? Because the pain has to be big enough on the liability side. Remember, I said it's 30 to 50% depending on the deal. Now, we're doing a cryptocurrency case right now for a gentleman. It's a $12 million cryptocurrency Ethereum that he bought for $100,000. And he's going to defer the tax of $5 million and move it into cash flow producing real estate. And for him, it was like a no-brainer because the money's out in outer space, right? As far as he knows. Whereas if you're in real estate and again, you're active and you're finding deals, then just do a 1031. It is simpler, right? And it is more cost effective. There's not ongoing fees. There's ongoing fees with us. We can talk about that as well. And if you're close to your health concern is close to, hey, I could be passing away soon. Well, maintain that stepped up basis, right? And get your kids to walk away capital gains tax free. However, just be very cautious. We don't know that's going to be there for sure, right? So we always say don't make decisions based upon what can potentially be changed.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.